Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the month that was June 2023. We are a national buyer's agency with offices in Sydney, Melbourne, Brisbane and Perth. We believe that there is always an opportunity somewhere. We help you to be a player and not a spectator in your wealth journey, focusing on quality properties over quantity, operating through 3 decades. Our experience will ensure no sleepless nights worrying about property markets. On this channel, we talk about all things property, but most importantly, I read the news and separate the facts from the fiction so you don't have to. Now, despite widespread recession discussions and a dozen interest rate hikes, all property research firms and banks concur that we've emerged from the housing market's lowest point earlier this year. Now, if you've been waiting for the bottom of the market, I have some bad news for you. You've already missed it. But we are at the beginning of a new property cycle, so don't miss it again. At Providence, we speak to dozens of would-be buyers every single week. Some of these buyers literally take years to commit to buying a property, and I can say that for every one of them, they would have been better off if they just made it a priority earlier. Now, I've said it before and I'll say it again. It's not timing the market. It's time spent in the market that's actually important. Now, people keep asking me, Jay, why aren't property prices falling? And here are some reasons. First of all, we got limited housing supply. So there is a significant shortage of the available houses in both sales and the rental market. And this scarcity tends to keep the prices steady or even drive them up. Next, we've got low vacancy rates and rising rents. So vacancy rates are below 1%, indicating a high demand for rental properties. As a result, landlords have the advantage in setting rental rates, which also contributes to the stability of their own personal housing prices. The third is low unemployment. Remember when the Treasurer said unemployment would get as high as 10% and even potentially peak at 15%? The current unemployment rate of 3.5% reflects a healthy job market where the majority of individuals seeking employment can find work. And this implies that homeowners are generally financially stable and capable of meeting their mortgage repayments, preventing a decline in property prices. High auction rates. Since March of this year, auction clearance rates have consistently exceeded 70%, and this indicates strong buyer demand, suggesting that there are more people willing to purchase properties at the current prices. Now, this factor further supports the stability of the housing market, and taken together, these factors create an environment conducive to stabilization or rising house prices underlying the current market's resilience. What I'm saying there in big words is that we're okay. This market isn't crashing. Oh, and also don't forget the over 750,000 new people that will enter our country over the next 12 months. It's evident that property prices and rents will continue to rise as demand for housing outpaces the available supply. Okay, according to the Australian Bureau of Statistics, on the 28th of May, Australia's population clock passed 26.5 million people. However, only a month later, at the end of June, Australian Bureau of Statistics estimate that we have been revised up and they now believe that there's 100,000 more people that they thought were actually here a month ago. So some accounting errors there. These high immigration numbers are likely to continue for some years, and they are occurring at a time when we just can't produce enough housing stock. These numbers will underpin our property market and our economy as these migrants have to set up new households. This will drive housing demand and continue fueling our economy. Now, just looking at some of these headlines here that I was looking at before, why migrants are our best chance at skirting recession, the impact of immigration explosion, is it about to rattle the property market? You can pause this, look up some of these articles, read them. Some of them are quite interesting with the data that they have. Now, looking at vacancy rates over the past 12 months, to start off here from May, we can see that Adelaide and Perth have the lowest levels of vacant properties in the country. So supply is still low, and we haven't built as many homes throughout the pandemic that we would have liked to. We've actually built nationally about 120,000 less properties than we would have if we built them at the same rate that we were achieving before the pandemic. So again, supply is low. And I even put a little bungee guy jumping off the levels here, because we currently are 26.4% below the 5-year average in regards to the amount of properties listed on the market at the moment. So that number just keeps dropping. And currently sales in the housing market are somewhat subdued, but however, the supply of property listed for resale and available for rentals remains extremely limited. And you can see there on the left, this data from Matuzik shows that 2021, 2022, and 2023, the numbers just continued to drop. 8.4% is the average of detached houses, 6.3 is where we're at for 2023, and 6.7 for attached dwellings, and we can see that we're down at 3.7, well below the 10-year averages for both of those numbers. I also thought it was important to take a little bit of a step back. Global residential real estate is worth $362 trillion. Despite a backdrop of high interest rates, most property markets actually remained resilient during 2022. This chart shows the nominal home price growth around the world. So overall, 3/4 of the 58 countries tracked on this report saw positive nominal growth. And again, you can pause this and have a look at this image. I think it's quite interesting. Global housing prices rose an average of 6% annually between Q4 of 2021 and Q4 of 2022. So in real terms, that takes inflation into account. Prices actually fell about 2% for the first decline in 12 years. Despite a surge in interest rates and mortgage costs, housing markets were noticeably stable. So real price remains 7% above the pre-pandemic levels. This chart shows historic price falls from peak to trough across our capital cities. And the present circumstances differ significantly from recent economic downturns, as they are categorized by low levels of unemployment, a significant influx of migrants, and severe shortage of homes, which collectively provide a strong foundation for the property market. So those three main factors are things that typically we haven't seen before during a housing downturn, which is why we think a recovery is going to be quick and imminent. This chart shows year-on-year property price trends since 1990. There have been only 6 periods where the year end was actually negative with house price growth. And even at the height of the 1993 recession and the 2008 GFC, the global financial crisis, property prices fell no more than 10% before significantly rallying as the conditions recovered. And look where we are now. Boom. I think we're going to have another recovery. Throughout our nation's history, and I know this isn't the best looking chart, but I wasn't going to make one myself, and I found the data here to be actually quite accurate. Housing prices have surpassed a 15% increase in a single year only on 5 occasions. So in each of these instances, a substantial influx of overseas arrivals triggered a property market boom that in turn resulted in an economic upswing. Presently, we are witnessing an unprecedented surge in overseas arrivals, the second time it's really only happened in Australia's history, as depicted by the graph, indicating that we are on the brink of our 6th housing price boom. Get on it, people. Let's talk about interest rates. Yesterday, the Reserve Bank of Australia, the RBA, has decided to maintain the official cash rate at the current level of 4.1%. So this decision follows a series of rate increases where interest rates gradually rose on a monthly basis, excluding April, of course, starting at 0.1% in April 2022. Now, the RBA Governor, Philip Lowe, the most hated man in Australia at the moment, and most probably the most misunderstood person, stated that the decision to keep rates unchanged was made to allow for a more comprehensive evaluation of the overall economy. Oh, thanks, mate. You're giving us a little break to read some numbers. Fantastic. This pause in rates is considered significant and definitely going to be welcomed by mortgage holders, particularly as inflation has been receding from its peak levels. Now let's take a quick look at the winners and losers for the month. Australian housing values have exhibited consistent growth for 4 consecutive months, with 7 out of 8 capital cities experiencing an increase in June. According to CoreLogic's National Home Value Index, there was a 1.1% rise in June, slightly lower than the 1.2% gain that we saw in May. But in June, all capital cities except for Hobart witnessed an upswing in dwelling values, with Sydney leading the way in the market cycle. Specifically, Sydney's home values surged by an additional 1.7% in June, resulting in a cumulative recovery of 6.7%, since the lowest point in January, mind you. Now, in terms of monetary value, the median housing value in Sydney is increasing by approximately $4,262 per week. So for people that are saying, oh, we're just going to wait and see what happens with interest rates, good luck saving $4,262 per week when you're ready to buy your home. Also, while Brisbane is also moving, it's second place, increasing by nearly $2,000 a week. So remember, it's not timing, it's time in, people. I've said it before, I'll say it again. Great chart here, rolling 3-month change in dwelling values for the state capitals. This was some examples I'm going to show you right now. This was a growth purchase. The suburb we chose has 10 years average growth rate of 9.75% per annum. Based on our purchase price of $848,000, the property should be worth in excess of about $2 million over the next decade. Yes, past performance is not an indicator of future performance, but hey, it's all we actually have. We pinpointed a great opportunity to buy under market value here, because they had tenants in this property. And when you're trying to buy a property, owner-occupiers do not want tenants that have maybe a 6 or 12-month lease still in place. Breaking that lease is very difficult. There's a lot of laws protecting tenants from you kicking them out. So because we were the investor, looking at a market that mainly has 70% owner-occupier purchases, we were part of only a very small group of people that were looking to purchase this property. So it was great time to be looking to buy. We actually offered below our assessed value, and we negotiated pretty hard for our clients. Our buyer was a time-poor overseas expat investor, and the client needed local knowledge to help them build a property portfolio that would outperform the average. Safe to say they're pretty wrapped in the result. This is a large 607 square meter block, very high land to house ratio, approximately 80% land, 20% house, which suited a high growth strategy for the client. Solid 4% rental yield, not the most amazing yield on the planet, but definitely higher than the average of 3.7% across the nation. Located within a wide, elevated street within the most sought after part of the suburb, only 11 kilometers from Brisbane CBD. Cosmetically renovated home, which was immaculate, really reducing any further maintenance costs. Great walkability to buses, transport, local shops. Only 2Ks from Westfield's Chermside, so giving you a little bit of a hint as to where this suburb is, which is the largest shopping centre in Queensland. Suburbs receiving growth from gentrification, high ratio of owner-occupiers in the area, well-regarded primary and secondary catchment zones, secured 3% below market value based upon recent sales, quality tenants in place, paying really good market rent, fantastic elevated street position. Recently, as I said, it's had some renos to it, so the client is just absolutely wrapped with this purchase. Another growth purchase, the suburb we chose has a 10-year average capital growth rate here of 9.21% per annum. So based upon that, we're hoping that this 650 purchase in 10 years' time, if the market continues the same trend it's done for the past decade, will be worth about $1.6 million. So really good prospects for the client here from Capital Growth. The client was a Melbourne-based couple, and they didn't know Brisbane at all. They needed local knowledge and expertise. We assessed the property value based on the most recent sales evidence, and under really strong competition, there were 5 offers. We made our best and final offer, which was actually below another offer. But the agent recommended our offer to the sellers because we were more certainly going to buy this property because we had cash. and that really did help us. It was only subject to a short building and pest condition, so that was really attractive to the seller, and they wanted it to get done. Highlights, it's 23 k's north of Brisbane CBD, below the top offer, as I said, because we gave them better terms. Terms are really important at the moment, everybody, when it comes to negotiation. Immaculate single level brick home on a 600 square metre block, really wide line treed street, 5-minute walk from local shops. Again, high land to house ratio, 75 to 25%. Really attractive home in like I said, a really nice street, well regarded middle class suburb, functional layout, no work to be done on this. Expected yield of about 4.2%, comparable with properties that have been rented at the moment. Great walkability. So really happy. This would probably be the equivalent of buying something in Borkham Hills here in Sydney, where I am. About $1.65 million would be your median house price, and about 1.79% would be your pretty pathetic rental yield. So we're looking at, $525 a week for the Brisbane property we bought at 4.2% versus $680 a week at 1.79%. So remember, you're paying 6% interest. And you need to make sure that income you're getting is minimizing that outgoing cost. So it makes lots of sense. Remember, we can't help you until you commit, and once you commit, we will not let you fail. We're bringing two things together here: your desire to build wealth and our 18 years of experience. So, this is how top-performing investors build wealth. Make sure you contact us. If you like what you've seen here and you want to be kept in the know with the Australian property market, make sure you like the video, hit that subscribe button. If you'd like to further your education, you can download our ebooks. The links are in the YouTube description below. I want to thank you for your time today. We will see you next month.